guys, Mr. Prez here with another quick video talking about how volatility is impacting your options and why you might be losing money even if your underlying has gone back up after a dip, even though your option premium is still getting killed. So if you know the basics about options, you understand that you have delta, gamma, theta, and vega. Um, without getting into any of the fancy math behind the implied volatility calculation, what you need to know is that volatility plays just as an important part in your premium pricing than just the underlying going up or down. When it comes to options trading in particular, you really want to capitalize on these sort of sharp moves up without stopping. You know, when you're going up nonstop, the volatility on your option is going to increase dramatically along with your delta and your gamma going up in addition to that. So not only do you have your delta from the underlying going up and your gamma adding to your delta, you also have your vega abnormally rising as well. So when you have dips, once you have a sharp move up followed by a dip, your implied volatility is going to start settling back to normal values after this sharp increase. And what happens is, even though you start to curl back up and retest those same highs, you're going to see that your options are not going to be worth the same amount of premium. This dramatic, $22 move on Peloton, we'll use the 100 strike calls as an example. We'll check out this options chart just to compare. And you can see August 27th was the start of this move. Pretty much 5 days of nonstop momentum. The volatility was massive to the upside. So you check the option chart over here. You paid $150 roughly for the contract on this breakout. And within 5 days, you go from $150 to $1,435. So you pretty much have a 10 bagger just on this breakout alone. But if you're trying to swing this October call, you tell yourself, well, I'm not going to sell it because I still have time on my contracts. So at the point of your highest volatility, your contract is not in the money yet, but hits a high of $1,400. So you tell yourself you're going to hold it, and on this downtrend, on this down move, what happens? Your volatility is going to settle, your vega is going to come down, go back to normal values, and your premium is going to decrease as a result of your delta is going down because the underlying is falling. You have your vega decreasing, so your premium is deflating back to standard values. And you also have people getting out of the positions from the initial breakout. So you have people selling on the bid, most likely to exit. Your volatility is going down, and your delta is working against you. So you look at the sell-off, and you have your diamond hands, and you're still in the position, and you notice, obviously Peloton starts to curl back up and retest that same level as before. But you'll notice on the options contract that once you get this retest of that high, where's your options contract? You're way down here. And if we extend this to the right, you can see instead of it being worth $1,400, it's barely worth $1,000 down here. So that's a pretty drastic percentage change just from the volatility. So even though you're heading back towards that 100 strike, the momentum is not as strong. The premium is not as inflated. So you don't have the same pricing coming into effect based off of that number alone. So the best strategy that you can do to take advantage of that is to buy the initial breakout, get into your position down here, sell all of your position up here when your Vega, your volatility is still high, and then simply buy back on the pullback when your volatility is calmed down and repeat the process. Because what happens is when you buy back down below, when after the volatility settles, you get in while your Vega is low, and then when you have your breakout move again, your Vega increases dramatically. So that's probably a big reason that a lot of people lose money buying out of the money options, is because when they get their first initial breakout, their premiums inflate, 100 to 300%, and they keep holding on to them, assuming that even if it dips, that once it goes back up, they're going to make another 200, 300, 400%, when that's just simply not the case. So just a quick recap, you have delta and gamma, which affect the price of the premium. You also have vega, which affects the price of the premium. When you have large spikes in either direction, your vega is going to inflate, which makes the price of your contract also inflate. And once you start having those corrections, that side